going to begin with a question that came in via email from Lance. Earlier this week, Lance had asked me about sort of day trading options. And it's not something that I do personally. And it's not something that's easy to backtest even with the PowerOptions historical tools, because our tools, the historical tools, look at the last price at the close of the business day. It doesn't show us intraday values. So Lance wanted to know, I've calculated price targets above and below the current price of SPY based on a price range established at the open. Either one or both of these price levels will hit about 90% of the time. I was wondering what strategies would help me take advantage of these price levels. Straddles seem too pricey. Buying straddles or buying strangles. Could directional butterflies be any better, and how can PowerOpt assist me in the decision process? So what do we have? We have a stock or general market indicator, SPY or SPX, that Lance feels he's able to pick price points that might hit and then retrace and then come back in an upper and lower price that might hit 90% of the time. So what strategies would we look for? Well, we'd want to see strategies that would match a profit or a profit level, both up and down to start with, but also with the concept that you might be rolling or adjusting those positions intraday. Again, I don't advocate personally day trading options. I don't do it myself. I'm not saying you can't be successful with it. It's just something I can't advocate because I've never done it, and I don't know how many successful traders I have that have been day trading options on a regular basis. But that being said, I told you guys a promise that I'll answer any question that comes in, so naturally I have to spend some time on Lance's question. So we have a stock that we figure might open here, and then at some point it might go here, and at some point it might go here. What are the strategies to take advantage? Well, as Lance mentioned, you have the long straddle and the long strangle. What's the difference? On a straddle position, you're buying a call and the put with the same strike price and the same expiration date. Naturally, this means you're paying into the highest time value if you're structured right at the current price at the open. Now, you could skew this. Let's say this is $299. Okay, so that's $299. That's at the open. But if you think it's going to be more bullish first, you could skew it one direction and maybe purchase the 300 out of the money call and the 300 in the money put. Might give you a similar risk reward, but with a different cost basis and different break evens. But you're skewing it to the direction you think it's going to go first in order to go the other direction. Or you might skew it by buying the in the money call and cheap out of the money put, expecting a bullish move, close the call, and then maybe buy another put if you expect it to retrace. This gets complicated very quickly trying to do the day trading with management involved. A long straddle is similar, but with a stock at $299, you might be buying the out of the money $295 put and maybe buying the 305 call. What does this do? It gives you a much lower cost basis as opposed to the straddle position that's right at the money at, say, 300. But then that also means you need a much bigger move to get to the lower break even or to get to the upper break even because your strikes are further apart. And since this is a day trade, they're decaying rapidly. Now, that's the one advantage I should have mentioned with SPY, why Lance is probably looking into this, is the next question might be, well, should I buy the 1 week out or buy the 2 week out or so forth? Well, the advantage of SPY and SPX is every week now you have a Monday, Wednesday, and Friday expiration. So on Monday, you could open the Monday position. On Tuesday, you could open the Wednesday. If you closed it, then on Wednesday, you could open the Wednesdays. And then on Thursday, you could open the Fridays. And then on Friday, you could open another Friday if you didn't keep the other position open. Okay, so this is why we're talking about SPY and SPX, for this advantage for day trading shorter expirations. But there's still, in the long aspect, whatever time value you pay into these positions, you're losing on one or the other. The opposite of that, of course, in my opinion, is fairly risky. The short straddle or the short strangle. Rather than buying the call and the put, we'd be selling. And again, at SPY, let's say $299, we might be selling the 300 call and the 300 put. Now, this is going to take in a high premium up front, which means we may have a very good upper and lower break even. So we're saying that if SPY stays in this range, we may have to pay to buy one option back, but we'll get the decay on the other, and we should still be in the profit zone, smaller movement. The short straddle, of course, is we'd be selling the out of the money, hoping they both expire at the end of the day if we're on an expiration, or we could buy it back more cheaply as well. Okay? Now, excuse me, the risk with the short straddles and the short strangles is intense. Now, as Lance mentioned, he's pinpointed target points where he thinks the stock's not going to go. That might be better for the short strangle position, where you pick the out-of-the-money call at the high point and you pick the out-of-the-money put at the low point, hoping it never breaches that. But this is essentially a naked call and a naked put. Yes, there's some different margin requirements for different brokers, but they're usually pretty close to the same. So this requires a very high margin requirement, a lot of capital to be tied up for this trade, which is why investors, and even as Lance mentioned, it might be better to go with some form of butterfly, either an iron butterfly or iron condor, combination of a bull put and a bear call credit spread. Well, the butterfly, the sold option, and the bull put and the bear call would be at the same strike. The iron condor, they'd both be out of the money. So split it right here. There's our bear call credit spread that's out of the money. There's our bull put. You can do these structures also just using all calls or all puts, which would be a debit condor or a debit butterfly. That's not what these two are on the outside. Ignore those for right now. Now, Lance had mentioned a directional butterfly, which could mean one of two things. It could mean that you're staggering the sell point away from the current stock price. So you're expecting a move upwards, so that's where you're setting the trigger there. You'd be selling maybe the 305 call and put instead of selling the 299, or the 300, my apologies. And that's fine, but there's also ways that you can skew the butterfly into a ratio as well in that case. Okay? For the condor, of course, we would just be out of the money in that scenario, but you could do directional. It's better not to mess with that. If you set up a condor or a strangle in that situation, you'd just be setting it far apart from the strike price of where you think the stock's not going to hit. What I have next to that is not necessarily what we'd call a directional butterfly or directional strangle position, or directional butterfly or directional condor. This is a reverse condor. In the original condor, what you'd be doing, as I mentioned, is selling the bear call spread. So we've got SPY, let's say, at 300. And we might sell the 305 call that's out of the money, and let's say buy a 307. So that completes the bear call spread. Above the straddle and strangle, we take care of the margin because we only have a 2-point risk. So this is our sell, and this is our buy. Here, of course, keeping the 5 points, we might sell the 295 put and buy a 293. Right? So we still have 2-point margin on both sides of the position. That's the most we can lose. If I reverse this, I buy the 295 put, buy the 305 call, sell the 307 call, and sell the 293. Now you've sort of done a debit spread instead of a credit spread, and you get sort of this reverse one, which is like the long strangle, but with a capped upside gain. Most people wouldn't want to do that. They'd rather just enter the straddle or strangle, so if there's a large move, they take more advantage in one direction or the other rather than capping it. And this, of course, would be that sort of debit butterfly, reverse buying the two here, selling on the outer wings. You get this V structure instead, but again, like the long straddle, would cost less because you're selling premium in here, but you cap the upside in one direction or the other. Okay? So this is what you might consider this as well. These are the ones you might consider to start with directional. My fear is that with what Lance was talking about is that he has an expectation at the open that the stock might move one direction or the other. It's not going to go to one range or the other, but it's going to go near this one first and then pull back to this one, in which case he might be buying just a call first, and then when that starts, sell that for the profit, and then buy the put option going the other direction, and then when he feels that's bottomed out, sell that for a profit, and then buy the call option. Very intense as far as watching time allocated to the strategies and more. Not something I do personally because I'm really, even though I'm on the screens all day and looking at my account, customers' accounts, I'm usually doing other things other than day trading the options. Now, those are things you could do. Okay, there's ratio spreads too, but they don't necessarily leave one direction open or the other. That's what we're talking about, is either trying to target a range where the stock might not get to with the selling, so you're still safe, or if you expect a big enough move to buy and then manage back and forth. But sometimes you have to look at, are the risks worth it? What do I mean by that? Now here's our weekly trend. All right, so this is Monday, and then we've got Tuesday, and we've got Wednesday, we've got Thursday, and this was Friday as well. Monday looks pretty good as far as selling goes, but there wasn't any big movements on the inside, was there? You didn't see a lot of shifting up and down. In fact, the height was probably only at about, didn't even breach 297, and the low started at the day at about 295. It's only 2-point movement in there, and it was very muted. You'd think when you see something along these lines, you'd be better off with one of the sell positions, the Condor, the short strangle perhaps, something along those lines. I prefer the Condor because it has the known risk. Not low risk, has the known risk. Okay? And it probably wouldn't have been a good buying because you wouldn't have made much money. Now Tuesday, however, I don't know how Lance is doing it, but he says that he feels he targeted 90% of the time. He would have picked, was seeing the movement at the open, he would have picked it here saying it's not going to go above 299.50, and I don't think it's going to drop below 298. Well, this here, if you get in somewhere in this time frame, that'd be perfect, even though expensive, as Lance mentioned, for one of the straddles or one of the strangles. But again, once you see that move up, you're going to have to take profits on that call and maybe leave the put open, because if you left the whole strangle open, you might not see a lot of profits in this range after the big run up, and then it comes back down. And this is the hard part about this. You see something along Wednesday's lines, and if you pick the timing right, we might be in a sell zone here, but that first hour or so, it did really ramp up. On a strangle position at the open, right about 298, you might have taken, let's say, the 300, and you might have taken the 297 or so as part of one of those short positions, the iron condor maybe, or the short strangle position. High margin, very risky. Excuse me. Now this might have worked out, but at the same time, right here, you're probably at a trigger point to manage if you opened early, because that big first move, you're going to start losing a lot of money on that call to buy it back. Now sure, you received something in that case, but you didn't receive a lot because it's a shorter term. You would have been doing it for Wednesday's expiration or for Friday's. Something on Thursday looks to be a little bit more bearish in that sense. And it is a decent movement. We start way up here, big gap open, but it didn't proceed to continue up. It actually pulled back very quickly and then settled down here. This would be a tough one to go for, because you might think at the open that this is something that's showing a bigger move, and you might try that long call that would have failed, or you might have tried a strangle, which might have just gotten back to break even. It's very tough to do. Is it a good idea to sell? Well, if you think this is at the top, when it hit that peak, you didn't get the trade in you wanted right away, it jumped up and it hit your top. Lance thought the highest it was going to go that day was 300, 350, and it hit there. Then maybe he could do one of those sells. But again, it dropped all the way back to about 298 at one point during the day. With the prices of the options at that time, you might not have gotten anything for the 296 or the 297. You might have been right at about that 298. You might have managed at this time for a loss, potentially. And then at the end of the day, it would have expired. And as you can see, Friday is a little bit of a whipsaw all over the place. Looks good here. I mean, big drop down at one point to 297. I know it's not that significant, but, you know, it's a 1% move in one day to the bottom, and then it came right back up to about 50% of the loss it took from the open. This would be kind of tough to play. And that's why it's sort of this answer of, you know, what strategy is best? If Fernando just popped that in, what strategy is best for day trading? I don't know. I honestly don't know, because I don't think it's one trade, Fernando, that's good for day trading. Okay? Fernando's direct question is, for day trading options, which is the best expiration for the structure that we choose? Okay? Oh, the expiration for the structure that we choose for day trading would probably be the shortest term weekly. Again, because you're expecting a really short decay if you're selling, or if you're buying, you're basing it more on the movement, but you want to pay less. You don't want to buy 2 weeks, 3 weeks, or 4 weeks at a time. It's my guess. It's not something I trade personally. So I think you're targeting the nearest expiration, whether you're selling or whether you're buying, to try to manage it. Now, that has a ton of answers wrapped into it, in the sense very quickly that how was I going to say this? Let me get to Sam's comments first. Yeah, I do see the other question that came in for Edison. I don't know how well we're going to be able to handle your question, Edison, and how much we're going to be able to do with that. It's a very distinct but tough question. So a more active plan, what Sam does in a sense, and Sam's been a regular here as well, he might, and you've heard us talk about this, Fernando, he might be buying calls and puts on SPY that are 1 to 2 to maybe in this case 3 months out in time. He said, nice gains in my 300 puts, long now in the January 2020 expiration. At that same time, Roku puts and beyond at 120. I was looking for moving stocks and buying puts in that case, okay? But we've had discussions about how trading just one stock, we might buy a straddle 2 to 3 months out and then make the adjustments or sell premium near term against this longer structure. That's what Sam might do, okay? Or he buys in based on the direction. When he thinks the direction's changing, he adds the other long leg in, okay? He also comments that many times you miss the trades and both calls and the puts turn into losses, especially in a whipsaw event. And we were talking about that there on Thursday. So it shoots up, and let's say that we are fortunate enough to already be in a call and we have some profit. Now, if we're lucky enough to call the top and we buy a put, we probably got some profit there as well. But when the move happened and it started to decline, if we didn't buy in here, that put is going to lose money. And the call probably gave some back as well. So you might not be at a profit in that scenario, depending on what structure you had and what trade you got off at the beginning of the day looking to do this. This is what makes it difficult. And then at any given moment, hopefully the wrench was thrown into the works prior to the market open, but we've seen a lot of wrenches thrown into the works during the trading day, where we've talked about this many times. Someone shoots a rocket into the Pacific, someone does something else, someone makes a comment on a social media platform during the trading day, and that trend that existed now goes thump. Now, that might be a better argument for why you want to be in the long straddle or the long strangle in case of the unexpected during the trading day. And this one's kind of interesting, isn't it? Well, again, it's a 1% move from about 297.50 to about 299. But that's a significant move in a 1 hour time period for SPY. Not something I'd probably wanted to have been opening a short straddle, short strangle, iron condor, or butterfly at this point with that large move upwards. That could cause a lot of problems and a lot of losses, depending on the event and what caused it as well. John, oh no, Sam, it's Sam again. To answer your question, Fernando, Sam's thoughts are, and I can't advocate for this because I don't do it, but Sam says the best for day trading is buy calls and have a stop at 10%. If it doesn't work, take a break. Okay, so there's a thought there from Sam regarding that he does this more and more. And of course, the one big thing that we have to comment there that we did is, as Sam mentioned, if you do any of this type, short, long, SPY, you're opening on Monday and Tuesday for the Wednesday expiration, you're opening Wednesday for the Wednesday expiration, Thursday for the Friday expiration, Friday for the expiration, you're glued to your computer. Okay, you're glued to your computer. And one advantage, I guess, now is that the floodgates opened. So pretty much now most brokers are doing the war where they're going into zero fees as much as possible. So the constant movements and adjustments you'd be making on day trading options might not cost as much as they used to a year ago, 6 months ago, 4 months ago, 3 months ago even. And that's really beneficial because a lot of attendees that we have here say, well, I like credit spreads, but I want to do weekly spreads and I want a good probability, but I'm only getting 5 or 10 cents and the commissions are eating a lot into that. Well, thankfully that stopped too. But day trading is the same way. I like the idea of day trading if I can pick the prices, but I'm going to have to pay a lot of commissions in and out. Thankfully, that's being eradicated in our favor as the trader. So that's good news for us and will help these positions. Okay. And Sam does comment that he'll do the sell positions that we were talking about. He do short-term trades, but in a sideways market that we're in right now, he's going long 3 months out, calls and puts, and then sells against those long straddles or strangles, kind of like I mentioned. Okay, so I apologize. Last part of Lance's question here, now that we've seen what can happen during a 5-day period, and it's an isolated view. Just this week, what happened with SPY. But his final thought was, how can PowerOptions help? Well, one of the tools we have is called the search summary. What this tool allows you to do is put in a stock. You can select an expiration time frame, and then just select which strategies you want to see of the 23 we support. So for Lance's case, I might go into the search summary tool, put in SPY, and look at long straddle, long strangle, short strangle and short straddle, which I probably wouldn't do, but I could have them there, iron condor, and iron butterfly. You could even select the longs if you wanted. Now, this will show you ideas, 1 or 2, maybe 3 ideas for each strategy that are within reasonable limits of an expectation, a good probability, and so forth. You know, probability between for an iron condor based on past performance, probability between for upper lower break even on an iron butterfly, and so forth. So this would give you some ideas on which ones are there and compare sort of the risk reward of the sell ones, but also look at the risk of the buy ones. Now, excuse me, once you pull up those results, you can link to the profit and loss chart, the custom spread tool, and you can run your what if scenarios. What would this short strangle or short straddle look like if SPY was at price X or price Y? Now, it's not an intraday. It's using the pricing models to do it, but it's not intraday. So you have to assume just at the end of the day, looking at it, what would be highest and lowest to compare those. But it's not looking at an hourly calculation. And it's a manual process. And of course, one of the tools we reviewed, I think, last week to find the calls or the puts to buy that would give you the best bang for the buck if the stock hit X or Y is the long option finder. You put in your stock, you put in your expectation and your expected target date, whether it's 1 day away or 30 days away, and it shows you which call or put would give you the highest return based on the pricing models as well. So those are the 3 ways I could approach it. Those are the 3 things I could do as far as PowerOptions to help you. But I think we've seen sort of a flaw here with this position, that you just don't know about the unknown, and you have to be right on your expectations, whether you're going long or short. The risks of going short with the high margin on the straddle and strangle, you can curb that with the butterfly position, iron butterfly or iron condor, still taking premium in. But those shifts here, not saying they'd result in large losses because it happened during the trading day, but the larger shifts would probably hit a trigger point in your position where you'd be forced to manage it, because if this continued up, you don't want to take that larger loss. But again, you don't, if it doesn't keep that same trend, you might have overmanaged the position, get out of the day with no profits, when it might have had a profit if you just left alone. And that's very hard to do, because you're making probably so much small profits on the days that you win that when you take losses, it's probably 3 to 4 times the gains you made the day before. And it takes a lot. It does take a lot, which is one of the reasons why I don't do it.